Good morning, good afternoon, good evening. In this video, we're going to be going over an order flow setup that I took the other day trading Bitcoin. This is going to be continuation from that video, the Technicals Tuesday video on September 20th. So we're going to be talking about a shift in control, a little bit of nuance with price action and order flow, and we'll wrap it up pretty quickly. Today, we are joined by none other than trading legend Kanye West. So give him a round of applause. If you're not subscribed to the channel, please go ahead and hit the subscribe button, hit the like button. And yes, that Kanye mention was to gain algo favoritism. Also, shout out to Phemex. Not only do they offer the lowest fees in the crypto market, over 100 spot and futures pairs, but now they actually have prediction markets. And I think this is awesome because it's really binary. The CME actually started this as well. So believe it or not, people can do a pretty decent job at anticipating where the market might be in the near future, but structuring a trade around that is the difficult part. Now, this is more than just with respect to assets. So as you can see on this front page, there is a market for the Fed decision. There's a market for, the US Open. So this is going to get really interesting. And if you want to sign up to Phemex, use the link below. So tradephemex.com, and they're currently running a bunch of different promotions, and that'll give you access to that. And it's a phenomenal exchange, extremely trustworthy team. To me, that's the most important thing. They didn't stick their neck out there like a lot of other exchanges that we saw, and they've done the right thing, and they continue to. So I am a partner with them, and I think that's a phenomenal exchange, and they offer phenomenal product. Honestly, it's the best execution across any crypto exchange that I've used. All right, so let's get into it. All right, so let's elaborate on a setup that I briefly covered in a video called Technicals Tuesday on September 20th, 2022. This was an intraday trade that I took. Most of my trading is intraday, at least during the bear market. I rarely hold positions overnight. Intraday trading for me doesn't mean scalping for ticks. So some people, when they say they scalp, they are trading literally for ticks, like some kind of pseudo market maker, bracketing prices, trading off of the DOM outside the spread. If I call myself a scalper, or if I say that I'm scalping, it's for trades that we're going to share right now, or trades similar to this. This is kind of the smallest version of my intraday trades. So this, I guess, could be borderline what someone might normally refer to as a scalp. But scalping just is a word that gets thrown around pretty interchangeably. A lot of terms in trading do, honestly. But this is a trade that was worth taking. When you're trading lower time frames, when you're trading smaller moves, you have to consider your transaction costs and whether or not they're even worth taking. But if you're someone who, let's say, just imagine that you're trading with one Bitcoin. If you're trading from 19,000 to 19,300, is that worth it for you? Right, capturing what would be just under a $300 move. Again, if you're just trading with one BTC, capturing under a $300 move, right, when you take away fees, is that worth it? And I would say for someone trading with one Bitcoin, it probably is worth it, right? $300 is a good amount of money for a small trade. So this has scaling limitations, obviously. You can't really trade multi-millions worth of contracts behind a $200 to $300 move. You can, depending on how you get involved and conditions, but right now things are thinner, so there are limitations. I'm trading with smaller size now. That doesn't mean trading with one BTC. It also doesn't mean trading with 3 million contracts. Anyhow, this setup was based on price action and order flow. This was based on a shift in control that I observed in both price action that was substantiated by order flow. So I didn't mean to say in both price action, but looking at both of those, the price action was substantiated by the evidence that I saw in the order flow by looking at the footprint. All right, nothing really context-wise. That's important to understand because context is very important in trading, but there are a lot of moves that happen intraday that are short-term momentum moves, short-term imbalances, and there's really no emphasis placed on context. It's great if it happens at a key contextual level or at a significant area or a significant location where, involvement has occurred previously, but it's not necessary to take a trade intraday with consideration of what is taking place. When I say context, in the bigger picture with macro, et cetera, et cetera. So this trade was kind of taken in isolation, and the context that I was observing was all local within this view. So it was really just what took place from here to here. And that was enough. It was at a key contextual level locally. The evidence in the order flow told me to take it, so I took it, right? And it happened to be a pretty effortless and painless trade. Okay, so this was about identifying the path of least resistance, the shift in control that comes along with that, and then just joining in on the inevitable momentum that shows up when you have some kind of trap that is formed. If you're looking at lower time frame price action alone, you could see this take place. There are a lot of setups where you have the market consolidating, and this is great evidence on the high time frame for reversal, where the market's moving sideways, bracketed very cleanly, highs and lows, takes out a side, involves a great deal of participants, and then completely reverses and finds support on the opposite side. And what I should say, as it takes out a side, it brings in a lot of new participation to the market, traps them, completely reverses the structure. This could be at the high or at the low in the opposite direction, and is suddenly looking quite effortless above a region where it was previously having trouble. So it signifies that some kind of change has taken place that was unable to take place previously, right? Previously, leading up to this, if it's in this direction, sellers were able to auction this down. They were, buyers were getting absorbed, et cetera, et cetera. So that is an under over structure. It's a great structure to spot on the low time frames and the high time frames. Obviously, high time frame evidence of this is going to lead to more follow through, as you would expect, right? High time frame, just think of it as more fuel. Here's what happened leading up to it. Just to give you some context, we have a sort of vacuous move down. So this leaves a gap, like an air pocket. Market briefly finds balance. Another gap move down, but smaller than the prior. So there is less momentum moving down. Again, finds balance. This time a longer balance than the previous one. So that's an important point to note. The fact that the balance was longer and the move down that preceded it was shorter. So there's some kind of shift in control that's taking place, whether it's a shift in momentum, whether it's absorption. Either way, it's becoming more clear in lower time frame price action. Now, any kind of gap like this leaves unchallenged positioning. You have people dumping into this that have no real clear invalidation. If the market comes and tests their positioning, they usually don't have any resolve. So these are the cutoff points you look at for continuation, honestly, where the threshold for the gap begins. So if this was going to continue down, the point is you should see it get cut off at the gap. So it should fail here, continue down, or worst case, fail at the larger gap up here. The minute the market starts to, and this happens to be a lower time frame chart, so we're looking at a 3-minute chart. So the 3-minute, right? But as soon as the market accepts back within one of these gaps, you usually see that it covers it pretty quickly back in the opposite direction. And again, it's unchallenged positioning. So let's imagine that you shorten here and you're thinking, I'm good because we're down here. You don't really have any kind of clear invalidation besides, oh shit, the market is at my entry. Let me get out. Everyone doing that in unison in a really thin environment leads to the same behavior that took place on the way down. So any kind of gap in market structure that moves very rapidly, the move that accepts back into that gap usually moves very rapidly as well. You start to see that over time, if you keep doing this, where you have a gap, then you gap up again through that one, you start to see that the moves down become a bit more efficient. So over time, if you're just using the same air pocket, you're going to fill it out. You're not going to keep, you're not going to just keep on zipping right through it as you did the first time or the second time. So this should fade with time, like the amount of velocity from point A to point B. So the market in this case recovers the gaps. So this is just a local setup, retests a key contextual level. So it was a 5-day long composite, and local market structure to get involved on the long side is back down here. Okay. It is back down there because this is an inefficient move back up. This is a very significant resistance, at least locally within the last couple of weeks. So buying this dip doesn't make sense. Waiting for this gap to fill does. So this is the best level to define a position locally, back down around that 18.8 level. We never got all the way back down there, but we got relatively close. This is the shift in control that we're talking about, the under over. This brief consolidation, breakdown, light continuation into a local key contextual level. Again, it's a point of control. It was a brief period of balance 2 times over. So balance, breakdown, balance, imbalance, up. So imbalance, balance, imbalance, balance, imbalance, balance, imbalance. So the last area of balance, the top side of that structure, is, it's the same kind of concept as retesting a prior value area high or prior, value area extreme. So it is the best local support level to look for some kind of interaction to form. I obviously looked at the footprint for this. So that's what we're going to focus on. This is where the shift in control takes place. So you have, prior to this move up, just to give you an idea of unchallenged positioning and those shorts closing, this gap through that prior gap occurs on declining open interest. So there are positions closing out, and they are shorts in that case covering, because again, they shorted the pocket on the way down. They were unchallenged on the way up. No real clear invalidation. It just makes sense for them to just close out where their entry was, or relatively close, before they, at least round trip it. So we have one move down, stronger selling coming in, and this is where open interest begins to pick up again. So these kind of consolidations, a lot of the times you're going to see these form. The breakdown is going to bring in a bunch of new positioning, right? Because you have kind of this flag that takes place, and a lot of people buy and sell flags on both the low time frame and the high time frame, because it looks like finally the market is resolving in one direction after being bracketed or stuck within one. And many times it works, because you have stops that are triggered, you have positions closing out, you have breakdown longs and shorts. So it does lead to momentum a lot of times. The key thing to focus on was that this broke down and immediately we trapped sellers below. So again, resistance, support, breakdown through support, a lot of new selling coming in, and yet the market is now suddenly trading higher. So buyers step up, we rip through the other side. This was the reason why I got long. So just think about it this way. Selling coming into the market before this was leading to results, right? The market was moving lower in the face of new selling coming in. Any kind of buying had been shut off at this level. Now the market is ripped above that level. We have a lot of selling coming in just this small rotation. And yet for the increased selling coming in, we're now holding a level that was giving us, the best way I could put it, was giving us shit prior. So we're holding that level now. And now the market is remaining bid. So we're getting more selling coming in, but the market is actually remaining bid in an area where it wasn't able to remain bid previously. So what this says is that there has been a shift in control. The path of least resistance is no longer down. If it was a case that it was down, we should see some kind of selling cause trouble at least. We shouldn't be having cases where you have selling coming into the market and the market is able to remain bid above that selling. If you think about it this way, think about the red side, right? That's the bid. When there is no bid, right? When demand is not there, any kind of selling in that direction, if we look at like a bid-ask spread and a depth of market, any kind of selling in that direction usually leads to this being depleted, right? If that's the bid and that's the ask, usually leads to that being depleted and not replenished. Whereas in this case, you have to imagine, I'm just trying to give you a visual, that as the market traded higher now this bid is staying firm right there, right? So no longer is this giving way to new selling coming in. And the concept of sold and hold is one that I use. And I shared a visualization of this many times over, but I talk about a flag forming on the low time frames in the face of increased selling. So all this is showing you is, hey, wow, there's still a lot of sellers coming in, but guess what? Suddenly they're no longer capable of having any measurable impact on price. So this was my entry. It was right here. And it was, the requirements for my trade were actually based on that remaining. So this is where we get into invalidation. My exit for the trade as a take profit is usually always going to be the next sticky area. So if we're looking at the market begin to find support above this consolidation and we have sort of the evidence and order flow, I'm looking at some kind of overthrow. So the next sticky area, the key contextual level from a prior composite, the local high that we just rolled off of, they happen to be in the same spot. So they're around 19.4, 19.3. I always take profit early. So that's why I take profit right before then. I front run any kind of level that even I point out. If I share it on Twitter, I'm front running it. If I'm thinking of it mentally, I'm front running it. Because chances are a lot of people are going to be doing the same exact thing. And then you're going to be left thinking as the market's moved against you a little bit, hey, is this going to come all the way back to my entry? Is this just stalling here before we move further up? I'd rather take out that uncertainty. Obviously, trading is all about dealing with uncertainty, but the entire trade thesis actually leans on this now. So my invalidation, and this is the part that most people ask about, my invalidation for this setup is this failing. So if I'm making a case saying that now price is remaining bid, and any kind of selling is coming in is being absorbed and it's not leading to any results, whereas previously it had on the way down. And I think it's important to understand that this was like 24 million contracts traded in a very small pocket. So it didn't lead to really any movement in price, whereas previous structures for similar volume amounts had a much larger range. So the amount of volume and delta that you see, if you have a range that is very tight, but you have a very large amount of selling, it obviously means that there is more liquidity, right? There's a firmer bid in this case. If it was the opposite, if we were on the top of this structure and we had a blue candle, or we had a candle at the high with volume above, it would be the sellers or the ask. But the invalidation for this trade is built around this. So now if this gets lost, my idea is wrong, right? If sellers start coming in and they're leading to lower prices, my idea that a shift in control has taken place here, and then we've had a trap, and now we've shifted control, and now we're going to squeeze up. My idea is, for me, it's wrong. So I end up just exiting this trade and waiting for, again, either maybe it continues to reclaim this level or there's further evidence of strength. But for the most part, when this fails, the trade it's completely off for me. And just one thing to add to this was just one piece of evidence to really refine the entry, but you have to think about this entire structure. So this consolidation is building longs and shorts on both sides, right? Well, you have to think about, we're building stops on both sides. We're building commitments within the structure. So just think about this structure as an area where risk got involved but never got rewarded. This is where it looked like it was getting rewarded, right? Where sellers looked like they were getting rewarded. So now you've broken lower, and in one big move, the market is reversed over the entire structure. So just think about anyone who got involved within this entire structure. If you considered that half of them were, if you could just consider parity, right, between aggressive longs and aggressive shorts, obviously there's a buyer for every seller, there's a seller for every buyer. But it's, a matter of, are you dealing with a market maker? Are you dealing with a passive participant, right? There's always someone who you're taking from. But if you just imagined, right, just for the sake of experiment or just example's sake, that both sides were equal here, if you're suddenly above all of that, you could at least make a slightly stronger case now that bears are offsides locally, right? Everyone who got involved here, out of everyone who got involved here, if you're going to say who's in better position when you're here, it's bulls, okay? And within the structure, you had a rise in open interest, so you have a case to be made for a slight amount of fuel that had built up. So this is all it is, right? It's a brief shift in control, okay, where previously sellers were being rewarded, where previously buyers were getting shut down. Now suddenly sellers are not getting rewarded at all, and we're trading above the levels where all activity was cut off previously either way. So it's an under-over structure on price action, but it's substantiated by sort of this sold and hold thing it's a phrase that I use, but it doesn't even sound catchy. But it's just saying to me now that the path of least resistance is no longer down. Again, think about it in these terms. Let's say you have a red candle that's like this and has a 25 million delta, right? Negative 25 million delta. And then you have a red candle above it that is the same delta, negative 25 million. But the range is a quarter of this range. So this candle moved down on that delta. Now this candle is higher and it's smaller on the same delta. So it's just showing you that things have really changed in terms of how thick the book has become under and how willing rather it is to stay there in the face of all that selling. And that's, you know, just a very low time frame indication of like this is a single rotation case of absorption. All right, guys, hopefully that was helpful. If it was, hit the subscribe button, hit the like button. Until next time, stay safe. And yeah, that's it.